Today the stock market didn't really do what it was supposed to do, and there is a lot of fear out there in the market. There is a lot of FUD being spread out. There is a lot of, different thoughts thinking that this is the end of the world. Pretty much it's going to be the end of the world in just a matter of numbers, because we're talking about recession, we're talking about inflation, not cooling down. We're talking about what the Fed is going to do. People are talking about everything is going to crash. This was just a bear market rally, meaning the green days we had recently was just temporary, and now we're going back down even lower than what we were in June. So let me give you some facts and my thoughts on that, and especially where I see things going and how to take advantage of it. All right. Now, the main reason that the market tanked today, not tanked, but really, ended up in the red instead of having a green day, because pre-market and even yesterday after hours, around 11 p.m. Central, the Dow Jones, the other indexes were already up by triple-digit points. Same thing this morning. So what happened? Well, an economic data came out, the U.S. consumer sentiment. The consumer confidence rises for the first time in 4 months on cheaper gas and slower inflation. In other words, people feel a lot more confident with where the purchasing power sits when it comes to their finances, when it comes to how far their money can go, just because of the prices of oil and gas declining significantly since, the beginning of this year. So they feel a little more confident when it comes to where inflation is going. All right. Now, it's a good thing in reality. Technically and truthfully, it's a good thing, because it means that people are not as afraid as they used to. And it means that, well, they might be feeling a lot more confident into putting the money back into the economy while spending. All right. Now, it's a good thing. Now, the good news now in this market is bad news, and vice versa. Bad news are good news. Why is this bad news for the market? Why is this triggering the market to sell off? Well, just because it means that when you add this data to what we had yesterday another data we had this morning around the job market, we have about 11 million jobs available out there, and people were really expecting something around 10 million some change. So it means, according to that data, the strong market is still very strong. But when you look at recession fears, when you look at people calling about a recession and calling about, especially what the Federal Reserve has said on last Friday, that they're going to be doing whatever in their power to bring down inflation, these numbers are pretty much giving them more authority, more power, and more green light. Why? Because it signals that the economy is still strong. And because the economy is still strong, with people, feeling more confident into spending more, it will fuel inflation back up. And they don't want that. They don't want inflation to be sticky. They don't want inflation to remain at high levels, because it means the economy is running too hot. And that's why people are selling their stocks, taking money off of the market and putting in the sidelines, just because it means that the Fed is going to do what it's supposed to do, which means raise interest rates. We've gone over, interest rates whenever they increase. It means more pain. These are the words from Federal Reserve, Chair Jerome Powell. More pain ahead for both businesses and households, people like you and me. So this is really the reason why the market is selling off today. But it was supposed to be a green day. Now, what to take when it comes to people talking about, recession fears, sell everything, the market's going to crash, everything. Now, I'm looking at two things. The first thing is, this is something that JP Morgan posted today. The stock market could see 11% upside despite jobless claims flashing recession signal, and these numbers around, the consumer sentiment. They say that when jobless claims move 10% higher than the prevailing 3-month moving average, stocks usually moved higher. In other words, stocks can go higher 10% from now. If we look at the jobless claims moving also 10% higher than the last 3 months moving average. Now, there is a caveat to that. but the indicator has also been a strong predictor of an imminent recession. Now, no joke. The thing is, we are already in a recession. Technically, we are already in a recession. So this is not a surprise. As of June, the US economy officially entered a recession. Now, something else to take into consideration. More young middle-class Americans flock to dollar stores seeking a refuge from inflation. Remember, the Dollar Trees, the dollar stores, Dollar General, these are stores where everything is supposed to be less expensive than your Targets, your Walmart, your anything else. But because prices have gone up, people are kind of going there, shifting there because they want to have cheaper prices. And this confirms that I've been also saying this for the last couple of months. People are now being more selective when it comes to what they want to buy, what they want to spend money on, because prices are going up. Now, does that mean recession is going to continue? Does that mean inflation? For me, it's a good sign that inflation might start cooling off on a consistent basis, even though it's going to be a lot less quick than we want it to be. All right. Now, on top of this, the stock market typically bottoms before the end of a Fed rate hike cycle. What it means is usually when the Fed, in terms of high inflationary times like this, is towards the end of the cycle to be over, the market tend to also bottom, meaning the market tend to stop selling off, and we can see a new bull market starting. As the Federal Reserve is committed to fight inflation, they're going to meet in September, and we have another meeting maybe in October, maybe another one in November. Not sure exactly, but the thing is, they have already increased interest rates 6 times this year. So more likely, they are about to end the cycle. And that's why stocks and the whole market can be at the very bottom before we can move a lot more higher. Now, people are using all of this to create a lot of fear in the market, because the Federal Reserve being committed to fighting inflation means they will have to create a recession. In other words, they will have to slow down the economy, and by doing so, they will create a recession, which is true. But they also don't want to overdo this whole correction, because they can create a depression. And a depression is really what we had in 2008, like no jobs, people, being laid off left and right, money and inflation being at double digits. They don't want that, because this is a vicious cycle which will be a lot more difficult to get out of. Because the bottom line is the US economy seems to be resilient. And as long as companies are making money and people are having jobs, which is kind of really the case, then it might just be a temporary thing. But as usual, people tend to overreact and over-exaggerate, because when it comes to money, we tend to be overprotective when we react to stuff, all right? So that is why I think if you take advantage of this whole fear being spread around, you might be able to secure yourself and increase your net worth by maybe a 0, a couple of 2, or maybe 3 zeros, depending on your savings capacity. Because if you get into some of the asset classes, whether we get into a depression, whether we get into a long recession or not, now is a good time, because everything's pretty much at a discount. Maybe except for some, real estate market. When you look at the stock market, whether you look at the tech sector, you look at the consumer discretionary, you look at pretty much everything. Even though we had a rally lately, things are still at a very discount price, including crypto. So if you continue to buy quality stocks in quality companies, with dividend, definitely give you a passive income, you will make sure that when we get out of this, because this will not long last, it will also get to a point where everything is ending, and we will get to the other side. When we get to the other side, then the bull market or the stock market will get to new highs. And that's how you will thank your future self for making the right decision and the right move today. All right. Now, if you are also interested into the real estate market, in some pockets, some markets, some locations in the US, and maybe around the world if you are outside of the US and watching, then it might be worth putting some money on the side, just because you might get into some, very interesting opportunities for anybody maybe being underwater because they went too aggressive with interest rates at 3%. And now that interest rates are going a lot higher and home sales are decreasing a little bit, then they find themselves underwater, and then you will get a deal, But the bottom line is, if you take advantage of these times where people are throwing the recession word, and the depression word and the end of the world when it comes to the economy, the stock market, that's you pretty much usually when it's a good time to buy, because in just a matter of couple of maybe 6 months and definitely a year or two, you're going to look back and wish you bought more.